Hello builders, my name is G. I just wanted to make a quick follow-up video to the kind of rant that I did yesterday about financial models and how they're really still needed even in the earliest of stages, because it's really important, as I've kind of put there in this Excalibur draw, for everyone. The fundamental thing that every business owner needs to know is their numbers. Let's jump right into it. So right away, I kind of segmented out. There's multiple different areas. I'm going to focus on B2C and B2B for now. And, just thinking about the earliest stage company, what are the easy things that you can track? How many users you have, and for B2B, how many logos are using your product, right? And they're not customers yet, right? Customer count is really available for both sides. The difference between a customer and a user is that a customer actually pays for the thing, for your service, for your product, whatever it may be. A user just uses it. And the difference that I would make there is to say that if I'm a toy company, the customer is the parent, the user is the child. Even if a child gets an allowance, it's really the parent who's the customer, brings the kid to the store and allows them to create a purchase. Ideal customer profile. If I'm a toy company, I'm probably targeting parents as the customer, children as the users, right? And so, if I don't have paid customers yet, my metrics is user count, logos, right? But really, I don't think it's unreasonable to expect that before you go raising around at VC or looking for a loan or hiring your first employee, that you go out and actually have paid customers. Either, you have Kickstarter, you have reservations, pre-orders, some form of proof that people are willing to pay for it, the service, the product, whatever. These are just assumed things. So, I don't think it's unreasonable to expect that there should be a customer count at some. From this kind of customer count, we really need to think about what are our goals, right? Laying out how many customers do I want to achieve at some point in the future. A business isn't rudderless. It doesn't just move in any random direction. You need to have some form of strategic thought and kind of chart out where you want your business to go. Is it a $1 billion outcome? Is it a $1 million ARR lifestyle business? Both are totally valid. There are different ambitions levels related to it, and there are different activities that need to be done. But without actually putting a thought of where the goal is, you won't know where your business is going, what decisions need to be made, and you can't communicate that with other people, whether it be investors, employees, customers themselves. So these goals are really important. Typically, we refer to them as either larger companies, they might have objective key results. For startups, it's more often than not key performance indicators. So extrapolating from the fact that most pre-seed startups should at least have this, an understanding of this, and that once those people pay, they become this, right? Then it shouldn't be unreasonable to say that, from this customer count here, if you have more customers, then we should measure month over month how many customers are we gaining, right? So this is the growth rate, and generally measured in percentages, right? If you're a B2B company, right, those percentages might be wild because one contract turning into two, that's doubling. You get 5 contracts. Well, that's an order of magnitude. And then 5 contracts become 20, and that's a crazy number. And the law of big numbers is the bigger the number, the smaller the percentages of growth that are possible. It's just how that works. And so, for large companies, you might actually just say by specific customer size. So I might actually just write this and I'll actually go down. So B2C typically measured in percentages B2B, this is measured in number contracts generally, right? You have a contracted customer when you're B2B. Slight adjustment there. All right, and it'll probably look better if I do this as like bullets there. Cool. So growth rate, that's a reasonable thing. At some point, you need to know if your company is older than 3 months and you have a product out to market, generally around the pre-seed, you're wading into the waters and trying to figure out if your business is going to work. What is product market fit, right? If you lay out, hey, we'd like to hit 50% growth month over month, and your business is falling short of that, you make an evaluation. Okay, was that 50% reasonable? Was it not? Should I lower it to a certain amount, or does this business not make sense at all? And so when you judge whether or not your business has product market fit, it isn't the wishy-washy answer of, you'll know it when you see it, or, you'll just get some vibes, some feelings that you have product market fit. No, let's add a little bit of precision to how we build our startups, measure it, have measurable metrics, and kind of work off of them. Set goals for yourself into the future and ensure that, hey, are we hitting those? If we're not, what's wrong? If we are these good positive signals? Did I undershoot the growth rate? Did I, not, am I not setting an ambitious enough goal? If you do hit product market fit, okay, great. This growth rate, if I hire an employee, is it expected that the employee is able to match this, right? I don't mean to presume, but maybe, hey, you're an amazing founder. You're founder-led sales. You have a abnormally high, hit rate. Maybe your SDRs that you hire, maybe not as great, or you're not as great at hiring people, so on and so forth. These are all the different things. That more you have your financial model, the more you can understand. And so growth rate is one thing, right? There's some basic things then, because you have, from this customer count here, what is the pricing, right? How much are you charging? There are different ways of thinking about pricing. There's a lot of different models. I'll just go over, or I'll just kind of list some of the major ones, but there's obviously more. The subscription is pretty popular for the most part because it gets charged monthly, and it helps in the way that you organize the metric. What is your monthly, I'll write it out, monthly recurring. So what is your monthly recurring revenue? Meaning that it's not just a point sale, it's not just a one-time thing. This is, they're locked in, they're going to be paying month over month unless they churn. That's a different KPI there. Since I just mentioned it, I'll include it over here. What is your churn / retention? It's the way that you want to put it, whether you're an optimist or a pessimist. If you're an optimist, you want to think about how many customers are we keeping. If you're more pessimist-minded, then you might be thinking, how many customers are leaving? Churn is low in B2B just because of contracting, so churn is probably less used in B2B, and so more so like how many customers retain their contract from year to year. For example, if it's a 1-year contract, how many people retain their contract year over year? I mean, using churn, it's ostensibly same. It's just the opposite. How many people left? B2C, you more so are concerned about churn because how many people download your app and then delete it or don't use it anymore, or use your service and they don't recommend it to anybody else and they don't continue using it ever again, right? Or they cancel their subscription. Churn. It's more important in B2C. So just going back to pricing, just so I kind of complete this. So obviously I just was talking a lot about contracts, right? So set contracts, $2,000 a year, $20,000, so on and so forth. So that's just a thought process there. You might have percentage fees. That's not a percent sign. So percentage fees, so you can kind of think of this as like utilities. So, however much someone wants to use your service, or in like the App Store's case, the 30% rake that you kind of take off the top. And so you have monthly recurring revenue. This is a metric that hopefully founders keep track of, right? MRR over time. You track that in some form of pie chart. You hope that it goes up and to the right, but usually sometimes MRR might be noisy because of churn and such. The early stages can, generally not a very flat thing. You might have like dips and all that type of stuff. But, when you take your MRR, if you're within a year old, you can take the average and then project out with your growth rate and then calculate either a projected ARR. So this is annual recurring revenue. To help you think like within a fiscal year, FY24, you take your MRR, your average, and then you multiply it by 12, you have your projected. And then you can possibly have your formal ARR when you're over a year. It's recorded, it's in your P&L. Always try to improve how much money you're making, right? So again, ARR, it's a typical startup thing because you try to chase that recurring dollars. So it's not necessarily passive income, but it's the closest thing that startups can have, right? Because it's just presumed that that money is going to be coming in because it's locked in a subscription, it's locked in a contract, right? Those percentages, fees, and utilities, those tend to be a little bit more volatile because it depends on market forces. Take a moving average, you can generally still do those projections. And so, look, in the pre-seed stage, right, you probably, if you're over a month old, the growth rate's kind of volatile, but there's a growth rate goal that you make for yourself. Pricing may change. Generally, investors will push you to increase prices to see kind of where the carrying capacity of a customer market is, how much they can afford. So you kind of push it until it starts to break, and then you lower prices a little bit to settle at a good kind of pricing equilibrium point. And then from the pricing, your growth rate, your traction that you've had within the few months, you have your monthly recurring revenue, how much it increases over time with the growth rate, and then projecting out what is this year going to look like, what is the next year going to look like, what are the next few years, considering you're going to keep and growth rate, again, because of the law of big numbers, decays over time. And so, you're probably not going to have 50% growth year over year. You're probably going to have 50 one year as your beginning. And then the next, it might be 40, the next 25, the next 10, until you start getting towards public market companies where, hey, they grew, 10% year over year. That's a growth company. Largest companies out there, they're growing by percentage, 1% to possibly, percentages of a percentages, right? Basis points of movement there when the companies kind of start plateauing, right? In a startup, it's all about growth. It's all about being able to scale out a working business model. And so these metrics are all in terms of money coming in, right? Churn and retention, I'll put that in the inbound column. So this is all stuff that's coming in. And then I won't say they're outbound metrics, but, technically, right? And so these are your costs, right? So some people may use COGS, some people may use other metrics, right? So this is FTE costs, right? So FTE, labor costs, so your salespeople, your engineers, all that type of stuff. Beyond equity holders, just the general infrastructure cost. There we go. Infrastructure costs. I guess this didn't spell it right. There we go. And that might be like How much does hosting your website cost? How much is the warehouse where you're selling your CPG product cost? How much is, um, you know, gas cost if you have to deliver yourself, so on and so forth, right? If you have marketing spend, all that type of stuff, I would call that kind of sales slash marketing, sales. We got to deliver a bottle or we got to send a bottle of wine to a high ticket customer. Marketing, we need to spend a certain amount on ads. Self-explanatory there. You have customer success. So this is customer success and service. So customer success, make sure that a customer is able to employ all features so that they're happy. Customer service, if they have some form of problem, you're able to service them. Those are all costs that you have incurred, right? And those dig into the revenue. And so when you create your pricing, you've got to make sure that pricing offsets your costs, right? And then that's what makes profits. However, some companies may decide to subsidize costs on behalf of the customer. The famous example that everyone loves to point to is Uber, right? Costs of Uber were subsidized earlier on so that customers got used to using it and were more somewhat locked into the product, right? As Uber gained market share and people were comfortable and used to using Uber, they were willing to subsidize that cost up until more recently, when they ramped up pricing to kind of take advantage of the fact that, or not advantage of, but in reality, or in light of the fact that their growth has basically kind of slowed as they've reached market saturation, they turn on pricing in order to become profitable and to make money off of their market share and their market position. And so those are reasons why, in the early stage, the math in and of itself may not make sense, but there are other reasons why you might go for it, right? And so I'll actually add something in here for growth rate, right, measured in percent, but, or actually, no, I already have it up here, the user count and the customer count, right? And so I'll actually add something here. What is the what is the market sizes? So we obviously have the SOM, selectable obtainable market, which is the SOM, and that's the kind of the beachhead customer segment. There, I'll bring this up a little bit. Selectable addressable market, SAM, which is all customer segments that can use the product as is. And then TAM, total addressable market, TAM, which is all customer that can use the future product line. That's how generally I describe it. I know some people kind of TAM as being like the totality for a singular product, but I like to think of it in terms of product lines. And so how, right, I think of TAM in that because do public companies generally stop at one product? Well, if we use the same Uber example, we have Uber, the car ride share service. We also have Uber Freight, right? And we have many other business lines that Uber has. And so the total addressable market for Uber turns out to be a large logistics organization, right? And so, if you envision that at the early stage, you can include that. Obviously, more heavy logistics stuff was probably not in the purview of, early Uber. But by me kind of morphing the definition of TAM a little bit, it allows for a founder and for the investor side to kind of think beyond the individual product and think about What are the horizontal and vertical spaces in which this company can embody, right? So that you can truly understand what is the potential breadth and scope of this company. If we're thinking on the big side, right, optimistic side, how big can this company be? Is it going to be one of the big tech companies, challengers up there? Or is it just constrained within an area? I can't imagine us building a product line out of this. And I think that for me personally, in how, selectable, obtainable market, it's the people you can reliably reach with your personal network and your personal abilities in, outreach and sales. That's that part there. Then the current product as it is, with maybe some minor, feature tweaks, but as the product is envisioned currently, who are all the people who could use it, right? And so when you expand from the SOM into that level of people, that's what I personally like to think about the SAM being. And then for the TAM, it's like, okay, there's this product, but then this product can kind of lend itself to reasonably build this product that's, in a horizontal space, right? We're not going deeper into a particular area. Let's say, again, like Uber, you have car rideshare, that's a consumer facing business. Now you're moving into more B2B logistics, right? With Uber Freight, and then, Uber Air, which is the airborne taxis. That's probably like, high net worth individuals flying in expensive helicopters and so forth. That's a different segment. And so if you would think at the early stages, where can we kind of dream up where this company could potentially go? That's what I kind of allow within a pitch deck, within a financial model, allow for a little bit of dreaming, right? It's still anchored to reality because there's some form of progression from beachhead to next area to, what is the big grand vision. Allow for a little bit of movement for dreaming, but still have it grounded in numbers. So obviously, to have a lot of this information here, probably more so in the seed stage, right? You feel that you have achieved product market fit by understanding more of what your monthly recurring revenue is. It's kind of stopped becoming volatile. The growth rate makes sense. You've dialed it in that, you can reliably predict and have as a target for your SDRs and for your team to hit reliably. Hey, we're going to go out. We're going to get 50% growth in the next month, which means we're going to go for 1,000 additional signups for the or additional downloads for the app, and that's 500%. That's this month. Okay, we blasted through that. Okay, next month we're going to challenge ourselves. Let's go for 75%. Okay, we missed that. We hit around 54. Okay, can we try for 60? Oh, we go out for that future month. Okay, the third month. Oh, we actually hit 61%. So maybe we can. Let's try another month. Can we hit that, 65%? Okay, no, we hit 57% growth. Okay, well, it sounds like probably our moving average is around, 55 conservatively, aggressively, 57 to 58% growth rate. And we're going to project that into the future given 4 months of us growing over time like that. That's just the basic financial model that shows that you're at the pre-seed stage level, you're trying to figure things out, and you're projecting forward. Okay, I raised this money. It means that this 50% growth rate, okay, because of this injection, we can now go and, reasonably try to target this number instead, right? I am able to get 1,000 people. If I hired 5 people like me, and let's say they don't get that 50% rate, but they're able to get that 40% rate, and you just take all those users and just contribute it to the number with the pricing, with the monthly recurring revenue, how much does this $1 million that I raise pay itself back? Will it be within a year when I plan to raise my future seed round? Those are the kind of conversations that you want to have.